By the end of this video, you're going to better understand everything 529 plans. Trust me, including what they can be used for, their tax advantages, and then how they can save you money while investing for your kids' future. First off, what is a 529 plan? Let's go into that. A 529 plan is a tax advantage savings plan designed to help you pay for your children's education. Originally limited to post-secondary education costs, it was expanded to cover K through 12 education in 2017 and then apprenticeship programs in 2019. The two major types of 529 plans are savings plans and then prepaid tuition plans. Savings plans grow tax deferred, and the withdrawals are tax-free if they're used for qualified education expenses. Prepaid tuition plans, on the other hand, allow the account owner to pay in advance for tuition at designated colleges and universities, locking in the cost at today's rates. 529 plans are also referred to as qualified tuition programs and Section 529 plans. When we say 529s, we're talking about that. Okay, let's talk more about to better understand these 529 plans. Although 529 plans take their name from Section 529 of the Federal Tax Code, the plans themselves are administered by the 50 states and the District of Columbia. Anyone can open a 529 account, but they are typically established by parents or grandparents on behalf of a child or grandchild who is the account's beneficiary. In some states, the person who funds the account may be eligible for a state tax deduction for those contributions. The money in the account then grows on a tax-deferred basis until it is withdrawn. As long as the money is used for qualified education expenses, as defined by the IRS, those withdrawals are not subject to their state or federal taxes. In the case of K through 12 students, tax-free withdrawals are limited to $10,000 per year. Okay, let's talk about the two main types of 529 plans. And the two main types are college savings plans and prepaid tuition plans, and they have some significant differences. Savings plans are the most common type of 529 account. The account holder contributes money to the plan, which is typically invested in a selection of mutual funds or index funds. Account holders can choose the funds they invest in, and how these funds perform will determine how the account grows, or worst case scenario, shrinks over time. Let's not hope for that. Many 529 plans also offer target date funds, which adjust their holdings as the years go by, becoming more conservative as the beneficiary gets closer to college age. Withdrawals from a 529 savings plan can be used for both college and K through 12 expenses. In the case of a 529 savings plan, qualified expenses include tuition, fees, room and board, and related costs. A 2019 federal law, the Secure Act, expanded tax-free 529 withdrawals to include registered apprenticeship program expenses and up to $10,000 in student loan debt repayment for both account beneficiaries and their siblings. Now let's talk about prepaid tuition plans. Prepaid tuition plans are offered by a limited number of states and some higher education institutions. They vary in their specifics, but the general principle here is that they allow you to lock in tuition at current rates for a student who may not be attending college for years to come. Prepaid plans are not available for this K through 12 education though. As with 529 savings plans, prepaid tuition plans grow in value over time, and the money that eventually comes out of the account to pay tuition is not taxable. Unlike savings plans, prepaid tuition plans do not cover room and board. Prepaid tuition plans may have other restrictions too, such as which particular colleges they may be used for. The money in a savings plan, by contrast, can be used at just about any eligible institution. Tax advantages of 529 plans. Let's talk about that. The earnings in a 529 plan are exempt from federal and state income taxes, provided that the money is used for qualified educational expenses. Any other withdrawals are subject to taxes plus another 10% penalty, similar to the Roth IRA, with exceptions though for certain circumstances such as death or disability. The money you contribute to a 529 plan is not tax deductible for federal income tax purposes. However, more than 30 states provide some kind of tax deduction or credit of varying amounts for contributions to the 529 plan. In general, you'll need to invest in your home state's plan if you want a state tax deduction or credit. If you're willing to forego a tax break, some states will allow you to invest in their plans as a non-resident. 529 plans also have very specific transferability rules governed by the Federal Tax Code, Section 529. The owner, typically you, may transfer to another 529 plan once per year unless a beneficiary change is involved. You are not required to change plans to change beneficiaries. You may transfer the plan to another family member defined as a son, daughter, stepchild, foster child, adopted child, or a descendant of any of them, brother, sister, stepbrother, or stepsister, father, mother, or ancestor of either, stepfather or stepmother, son or daughter of a brother or sister, brother or sister of father or mother, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law, or the spouse of any individual listed above. Or, bonus, first cousin. There's a lot going on there. Basically, there's a lot of cases where you can transfer to a family member. We'll just leave it at that. All right, but let's talk about the rules, because these are important. You gotta know the rules to take advantage of this plan. There are 2 key participants in each 529 plan, the account owner and then the account beneficiary. And in some cases, these can be the same person. US citizens and resident aliens 18 years or older with a valid social security number or taxpayer ID can open an account, and there are no restrictions on who can benefit from the account. Of course, the most common account owners are parents and grandparents, right? And then the most common beneficiaries are minor children and grandchildren. Account owners act as custodian of the funds, and they are able to make all investment decisions until these funds are withdrawn. Account beneficiaries, on the other hand, are the individuals for whom the funds will be used. Each account can have only one beneficiary, but the beneficiary can be changed to an eligible family member of the original beneficiary without incurring any federal taxes or penalties. But we're not going to go into that one again. Federal deductions for 529 plans. There is no federal deduction for contributions to the 529 account. At the federal level, contributors should keep in mind that contributions may be subject to the federal gift tax laws. So in the year 2022, you can give up to $16,000 to someone before the gift tax kicks in, or $32K for married couples combining gifts, which is up from $15K in the prior year, or $30K for married couples. There is also an option to make a larger tax-free 529 plan contribution, called superfunding, if the contribution is treated as if it were spread evenly over a 5-year period. For example, an $80K lump sum contribution to a 529 plan can be applied as though it were $16,000 per year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. State deductions for 529 plans. At the state level, many states offer a deduction, and few states offer a credit. Deductions typically will only be relevant if they help the contributor bypass the state's standard deduction level. Over 30 states offer a state income tax deduction or state income tax credit for 529 plan contributions. In most states, residents must contribute to an in-state 529 plan to be eligible for that state income tax benefit. However, in Arizona, Arkansas, Kansas, Minnesota, Missouri, Montana, and Pennsylvania, contributions to any 529 plan qualify for an annual state income tax benefit. Tax credits offer the greatest advantage as they are subtracted from the amount of tax the taxpayer owes overall. Indiana, Utah, and Vermont are the 3 states offering a tax credit, which is even better than a deduction in most cases. So let's talk about the limits on the 529 plan's state income tax benefits. In Colorado, New Mexico, South Carolina, and West Virginia, 529 plan contributions are fully deductible from state taxable income. Other states limit the amount of contributions that are eligible for a state income tax benefit. For example, in Pennsylvania, residents may deduct 529 plan contributions up to the amount of the annual gift tax exclusion from Pennsylvania taxable income each year. In Massachusetts, residents may only deduct up to $1,000 per year of 529 plan contributions from Massachusetts taxable income. So let's talk about the other considerations that you might have for 529 plans. As with other kinds of investing, the earlier you get started, the better. Time is on your side, right? Always the case. With a 529 savings plan, your money will have more time to grow and compound. With a prepaid tuition plan, you'll most likely be able to lock in a lower tuition rate, since many schools raise their prices each year. If you have money left over in a 529 plan, say the beneficiary gets a substantial scholarship or decides not to go to college at all, it happens, right? You'll have several options. One is to change the beneficiary on the account to another relative. Another is to keep the current beneficiary in case they change their mind about attending college or later go on to graduate school. If worse comes to worse, you can always cash in the account, withdraw all the funds, and then pay the taxes and the 10% penalty. However, that's the last case scenario. How can you open a 529 plan? Well, 529 plans can be opened directly with the state's plan. Alternatively, many brokers and financial advisors or robo-advisors like Wealthfront offer 529 plans where you can choose from among several plans located around the country. Who maintains control over a 529 plan? Well, the 529 plan is technically a custodial account. As such, an adult custodian is the one who controls the funds, but for the benefit of a minor. The beneficiary can then assume control over the 529 once they reach 18. but the funds must still be used for qualifying education-related expenses. The biggest question of them all, what are qualified expenses for a 529 plan? Well, qualified expenses for a 529 plan include all of the following. Get ready, this is a long list. College graduate or vocational school tuition and fees, elementary or secondary school tuition and fees, books and school supplies, student loan payments, off-campus housing, campus food and meal plans, computers, internet, and software used for schoolwork. Student attendance is required there. Special needs and accessibility equipment for students. And that's it. All right. Thanks so much for watching. Hopefully this gives you a better idea and better understanding of 529 plans. I'm Tony from Wealthfront. Take care.